Stocks swing between losses and gains in a subdued trade amid signs of slowing growth and uncertainty over Trump 2.0 policies. Realty and consumer durables climb while utilities and financials drag. Midcaps eke out gains.
India's Q2 GDP growth drops to a shocking 5.4%, way below the estimated 6.5%, fueling expectations of RBI easing liquidity, even as high prices may push back a rate cut to February.
Aster DM Healthcare and Blackstone-backed Quality Care are set to merge and create among the top 3 healthcare chains in India. The EPS accretive merger will have Blackstone as its biggest shareholder.
Bajaj Finance and RBL Bank have decided to stop issuing co-branded credit cards after the RBI tightened rules for such relationships. This move is expected to dent RBL's growth. The stock snips.
And two-wheeler wholesale saw some growth in November, led mostly by exports, but passenger vehicles barring SUVs, tractors and commercial vehicles remained in the slow lane. Meanwhile, legacy players narrowed the sales gap with Ola Electric in the electric vehicle two-wheeler segment.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me is Hormuz Fatakia. It seems like a day where the frontline indices pressed a snooze button after an extended weekend, but the important part is that the broader markets are showing signs of life today. We have the mid-cap index doing well, the small-cap index does a lot better, and we have a bunch of these pockets which are seeing a fair amount of fireworks in today's trading session. Case in point, something like, Inox Wind, which is up 9%, Axis Cades, which is doing well, AGI Greenpack, a bunch of stocks. More of that, what we'll talk about in just a bit. So if you look at the advanced decline ratio, we have 1,500 stocks on the NSE advancing for about 918 stocks, which are under a wee bit of pressure today. So good going from a portfolio standpoint, Hormuz.
Good going indeed, and it's a recovery as well from the lows of the day for the Nifty. So it's not as bad a start as it was feared after the second quarter GDP print that came in last Friday after market closing hours. We did open lower, fell about 100 points, and then it's been a very recovery from the lows, but then we've continued to trade around that flat line. What's doing well though among the sectoral indices? As always, real estate continues to do well, almost 2% higher for the realty index. The small cap index is up around about 1%. The mid cap index is up 0.6%. The pharma index is up 0.8% as well in today's trading session. So the pharma stocks continue to move from where they left off last Friday. And there are plenty of movers within the pharma space as well. One of them is Aster DM, and that is after a confirmed news break after Aster DM announced a merger with Quality Care Hospitals. And Rachna, who broke this story, is here with more details and what brokerages are making of this move. Rachna, tell us more.
Right, it is a CNBC-TV18 News break confirmed. We had first reported on August 5th exclusively that Aster DM and Blackstone-backed care hospitals were looking to go in for a merger, and now the announcement has come in. We in fact spoke to the management this morning. But speaking of the merger first, together these two hospital chains coming together will have a bed capacity of 10,150 beds, making them the second biggest hospital chain in the space. The merger is supposed to be EPS accretive from the very start. This announcement also makes hospitals under Aster, Care, KIMS Healthcare and Evercare all under one umbrella, which will be the merged entity, the Aster DM Quality Care, which will be the name of the new entity. Speaking of the ownership pattern and this merger, the deal contours of this merger, Aster will acquire 5% stake in Quality Care, and in turn, Blackstone and TPG will get 3.5% stake in Aster DM from the promoter family. This will give Aster shareholders 57% and QCIL shareholders about 42% in the merged entity, whereas Blackstone will be the single largest shareholder in the merged entity at 30.7%. Aster's promoter family, that's the Mopin family, will hold about 24%. The Aster's public shareholders at 33%, and others, which also includes TPG Capital, by the way, at about 12%. The combined entity is expected to have revenues of about 7,314 crore with a post-Ind AS EBITDA of 1,396 crore and ROCE of 18%. The bed capacity, like I said, currently exceeds 10,000 beds right away with this merger. But the plan, as what management told us this morning, is to go up to 13,300 by 2027. With an occupancy rate of 65%, the average revenue per occupied bed, that's the RPOB, stands at rupees 39,100, and this will make the merged entity the second biggest hospital chain in the country.
when we look at our margins right now, EBITDA margins around 17%, it actually moves up to 19% in a post-merge scenario. So, which is why, exactly like you said, it's EPS accretive from day one. This merger, it values the entire deal at more than $5 billion. So we believe that this is one of the largest healthcare transactions this year. So we should be able to see the additional 10 to 15% EBITDA margin expansion, maybe in sort of 2 years. 24 months to 36 months is when you really start unlocking those synergistic opportunities, to be honest. Aster has been outperforming its peers, and we have been growing much faster than most of the peers in the industry. We expect at a combined level, we'll still be able to be close to 20% CAGR. I think what has happened also is since Blackstone has come in, there's been a lot of investments that they've been making in terms of infrastructure upgrade. So I think there's been a little bit of a delay in some of those investments paying off. But at a combined level, we expect that we should be able to do still a 18-20% revenue CAGR over the next couple of years.
A big merger there in the healthcare space and Aster DM2 trading with gains of close to 3% in today's session. The other big event that took place over the weekend was auto sales, and now electric two-wheelers are in focus. Sudarshan is joining in with that from the latest numbers from the November Vahan data. Sudarshan.
So as per Vahan registration data for the month of November, there is a sharp drop in market share for Ola electric vehicles. And the gainers are TVS Motor and Bajaj Auto. If you compare from the October month, Ola Electric's market share has dropped 500 basis points and now it stands at 25%. And for TVS Motor, market share is now 23%, that is up 100 basis points. And for Bajaj Auto, it's at 22%, and that is up 200 basis points month on month. If you talk about the registration data, Ola Electric sales were down 2% year on year, and for MOM, it's down 30%. TVS Motors sales were up 41% YOY, but down 10% month on month. And for Bajaj Auto, sales have increased sharply. It was up 120% year on year, but down 7% month on month. If you take a look at the market share since the beginning of FY25, in the start of April 2024, Ola Electric's market share was 52%. Now it's almost halved, and currently it stands at 25%. For TVS Motor and Bajaj Auto, market share for both these companies in April were at 11%. Now TVS Motor's market share stands at 23%, and for Bajaj Auto, it's at 22%. So despite the several launches that Ola Electric has made in last few months, company continues to lose the market share in electric vehicle segment.
All right, we take that point. Thank you so much for putting that into perspective, Sudarshan. But, you know, there are a bunch of stocks which are now spiking. And we have one of them, which is in the form of Dixon. This, as the companies began the production of Google Pixel smartphones in its Noida unit. Upasna joins in with the details. There's also a brokerage note that has come by on this development. Upasna.
Well, the stock continues to remain in focus today as it launches mass production of Google Pixel smartphones. Mind you that the company's wholly owned subsidiary, that is Pagid Electronics, had entered into a contract manufacturing agreement with Compal for manufacturing of mobile phones. And the company commences the production for the same at its Noida unit. Now, on the back of this development, Nomura has given a buy rating with a target price of 18,654. It says that the China Plus One can lead to a significant long-term potential for Dixon from Google. It has also estimated that it can potentially add 1,500 crore of revenue to the company, 4% of FY26 smartphone sales. It says that this will showcase Dixon's capabilities to make premium phones and will be a long-term key positive for the company. Now, looking at valuations within the EMS space, Dixon currently trades at 90 times one-year forward PE, which is expensive as compared to the other listed players, such as Keynes, which trades at 88 times, Amber trades at 54 times, and Sirma SGS, which trades at 44 times. So all in all, the stock remains in focus today on back of this surging high in trade today.
Remains in focus today, has remained in focus for a better part of this year as well. Upasna, thanks a lot for that. 6% higher on Dixon, 15% up in the last 1 month, 150% up so far this year. Almost unstoppable. Nomura's price target now is almost 18,500 for Dixon Technologies. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned.
hearty congratulations to all the CNBC viewers and CNBC team. It has been a wonderful journey. A country like India, which is coming up, which is developing, it requires correct information, timely information, and correct advice. And somewhere on the line, I think CNBC has played that role. So we, sitting in exchanges, we are really proud and we are really happy that we have the media like CNBC, which is able to provide information not only in English, but also in other languages to all the investors about what is correct, what is not correct, what to do, what not to do. Because in investments, it's also important to tell what not to do. It's always exciting to go after things which are sort of going to do well. But also there are precautions to be taken. It's a risk capital. And for me, in some ways, the stock markets are the markets for risk, but they also create trust. Trust in the entrepreneurs, trust in the system, trust in regulators, trust in Indian system. And I think it's very difficult to create that trust, very easy to give up that trust. And I think CNBC-TV18 group is playing a great role in ensuring that the trust is maintained, and whenever any part of the ecosystem errs, CNBC cautions them. I think that is the biggest function you guys perform in terms of showing the mirror, and that's very important.
Welcome back. Pull up something like a Swiggy that's doing well. It was one of the bigger gainers of all of last week, and right now this morning as well. Opened in the red from there. Seen some purchase from the lows, currently at the high point of trade. So pull up the intraday chart of that one, comes up for you. Kolte Patil, a lot of the real estate stocks are doing extremely well. So we have something like a macro tech developers as well, which is doing extremely well in today's trading session so far. But the headline of the weekend was the data that came by post markets on Friday, which was the GDP data that the second quarter GDP for India grew at a shocking 5.5%, 5.4% to be precise, against expectations of a 6.5% growth. Following this, the economists have slashed their full year growth forecast to anywhere between 6.5% from earlier 6.8 to closer to 7%. Hormaz, what are the brokerages making of this? And more importantly, this Friday we have the RBI policy meet as well. What are the expectations?
That'll be the big talking point, right? What is the RBI going to do about this? Because the clamor is now growing for a rate cut, considering you have seen a GDP print like that, which is down to a 7-quarter low. But now the views that are coming in, that JP Morgan saying that despite this cut, the first rate cut they are expecting is only in the month of February, is what they're saying. Although the odds of a rate cut on Friday have increased, but they as a base case are expecting a rate cut only in February. But they may see some liquidity measures that the RBI can announce when it comes to easing some of the liquidity stress. Now, what Citi has cut its GDP growth forecast, which is now down to 6.4% from 7% earlier. And what they say is that now they are in this low growth, high inflation scenario, right? And this, because of this high inflation, the possibility of a rate cut in this policy in December is out of the way. But the RBI may announce a CRR cut to ease the liquidity pressure, is what Citi is saying. Now, Goldman Sachs has cut its CY24 and FY25 GDP expectations to 6.4% and 6% respectively. That's what Goldman Sachs has done. And on the flip side, they have maintained their CY25 and FY26 GDP figures at 6.3%, is what Goldman Sachs has done. What Jefferies is saying is that the slowdown in government spending and bank credit growth is what both these issues are transitory in nature, and they should reverse in the second half of FY25. And because of this GDP print, the possibility of a CRR cut in this policy goes higher, is what Jefferies is saying. Now, what Morgan Stanley is saying is that they are expecting the rates to remain unchanged this time around, but the RBI may announce some liquidity easing measures like an OMO, is what they are saying. While some of them are saying a CRR cut, Morgan Stanley is expecting an OMO, or an open market operation, to be announced. So this is what the view is coming in from the street. There is a consensus cut for GDP growth estimates, but what will the RBI do this time around? That remains a divided house.
Absolutely. Let's see where that comes by or not. Now, the second quarter GDP number coming in at 5.4% makes the RBI meet on 6 December even more interesting, as we've been pointing out. Whether there will be a repo cut or whether there will be a CRR cut, Lata joins in and tells us what exactly is likely to happen, and more importantly, what does it mean for the banking stocks? Lata.
Yes, that's right. At 5.4%, it's such a shocker. It's that expectations are normal that the Reserve Bank has to do something. And that, its priority is inflation, keeping CPI at 4% plus or minus 2. But now growth also becomes a priority, maybe even a slightly higher priority. As it is, we know ministers like Piyush Goyal have been saying that a rate cut is called for. Now, what economists say is, how can a Reserve Bank whose mandate is 6% inflation do a rate cut when the last inflation number is 6.2? And for all you know, November also will be close to 6% CPI. It's hugely going against its own mandate. And so is there a chance that they will actually lose in liquidity? Repo rate is the price of money. Liquidity is the amount of money. So a CRR cut can increase the liquidity. Now, let me tell you what the impact on banks can be. Repo cut. If you cut the repo rate, then there can be a negative short-term impact on banks, because under new rules after 2012 or thereabouts, the interest rate, lending rate is linked to an external benchmark. It's called EBLR, external benchmark lending rate. So, home loans, corporate loans are all linked to either the repo or the T-bill, one of the external benchmarks. If you cut the repo rate, then all these loans will earn the banks less. But the cost of money, which is deposits, will go down slowly. So immediately, there will actually be a negative impact on bank margins. When liquidity is tight, a repo rate also is less effective. But importantly, for the banks, it is a short-term negative. Let us look at what happens in a CRR. What is the CRR? It is that part of your deposits which you cannot lend, which you have to keep idle as cash. At the moment, for every 100 rupees, 4.5 rupees CRR of 4.5% means 4.5 rupees cannot be lent. It has to be kept idle. But that money is being raised at 8% or something as an FD or whatever by the banks, but it's not earning anything. Suppose that comes down to, say, 4.25. Then a 0.2, now what is actually being released that you can lend? 0.25% of the total deposits in the system, which is 230 lakh crore. So 0.25% of that is something like 57,500 crores or thereabouts can be lent. It was earning 0, it will now earn something like 10%, 11%, depending on what loan you're giving. That means margins for every 0.25% cut in CRR can increase by about 2-3 basis points. If it's a 0.5% cut, then it can increase by 5 or 6 basis points margins. I mean, that's just blanket. Everybody's margins improve. Now, this is the first shot. Every time you give, a deposit has a multiplier. It's called the money multiplier. For instance, we get our salary from the company. It shifts from their deposit to our deposit. An additional CRR instead of 4.5 will become 4.5, 4.25 or 4. Then I pay my child's school fees. That goes to another deposit. Again, a further 4.5 has to be kept. No, now they have to keep only 4%. So there is that is called the multiplier effect. So the ultimate impact on banks over 6 months can be more. That's the basic thing. For banks, repo is slightly negative in the near term. CRR is positive in the near term and in the medium term.
All right, we take that point. Thank you so much. Repo cut is slightly negative in the near term. CRR is a positive in the near term itself. What we'll do is take your leave on that note on a short break. Come back, focus on a bunch of other stocks which are buzzing around as well. And mind you, a lot is happening in the broader markets. Very interesting day of trade, a bunch of individual stocks. Let's call it an individual stocks heavy day itself. So you have, the Nifty, which is absolutely flat, just about 36 points on in the green right now, has been meandering around the flat line itself. But look at something like an Indian Hotels, a bunch of stocks doing well. Indian Hotels is now suddenly spiked to the high point of trade currently with a gain of almost 1.3% seasonally, entering into a strong quarter. And that's exactly, the kind of stocks that are moving around as well. If you look at it, the frontline indices that we have, the Nifty is just about in the green. The Nifty Bank is actually underperforming, and we have the mid-cap index doing a lot better, 0.2% higher. What's doing even better is the small cap index, which is up around 1% almost. So we have more stocks advancing, way more stocks advancing than the number of stocks which are declining itself. What are the stocks that are doing well? We have the cement pack, Ultratech, Shree Cement. We have, JK Cement, Dalmia Bharat, all of them doing extremely well. Post monsoons, maybe, the street is clamoring for some sort of increase in demand, though the price increase is something that we'll be watching out for. A bunch of these textile stocks doing well as well. It's colder in India this time around so far, so Monte Carlo doing well ahead of the wedding season. We have Siaram Silk Mills and a lot of these others as well, the ones that export to the US on account of a firmer US dollar, doing even better. So Himmat Singh Seth up around 8%. We spoke about the wedding season, Indian Hotels doing well. Just take a look at a couple of these jewelry stocks, PN Gargil, PC Jeweler, TBZ, all of them up anywhere between 4 to 6% itself. Then the question is, what happens to the Nifty? Well, we have the 24,000 put extremely active for a premium of close to around 90 rupees. 24,100 put writers also fairly active. But on the way up, we do have the 24,200 call writers and the 24,300 call writers, both of them equally active as well. So look at the 24,200 call, almost a 150 rupee premium. What does all of this mean for the frontline index? Strong support around 24,000. If not, then we have just below that 24,000 mark, the 20-day moving average. And on the way up, between 24,300 to 24,350 is the resistance zone. But because it is such a stocks-driven market, keeping an eye out on RBL Bank as well, it's been fairly volatile, may enter F&O ban on day 2 of the December series.
A very pertinent question that Mangalam asked, right? What happens next to the Nifty? We'll ask that question to Manish Hathiramani of Deendayal Investments, who joins in with that and his trading recommendations on the other side. Stay tuned.
Congratulations to all of you at CNBC. And this is an occasion for you all to celebrate because of what you have achieved. I'm a regular in watching CNBC, but this is also a moment for you to resolve how do you raise your standard even further in the next leg of your journey. So build on what you all have achieved, but dream high and set very high goals for yourselves.
Back with us here on Halftime Report, the Nifty 2 is heading back towards the highest point of the day. What should one do now? Manish Hathiramani of Deendayal Investments is joining us to answer just that. Manish, good afternoon. Thank you for joining in. Well, it's been this range, right, for the Nifty, 24,000 on the downside, 24,350 on the higher end. What does one do to position themselves now on the Nifty, considering this range-bound action that you're seeing, and couple that up with your stock recommendations as well for the afternoon?
Good afternoon to you, Hormones, Mangalam, and to all our viewers. Well, 23,500, in my opinion, has been a very strong base formation, and that is ideally where we have bounced from. Having said that, I feel the current immediate short-term support is about 23,700. And on the upside, we have 24,350 to be precise as a current resistance. I would be very cautious trading over here, and hence I would wait for either levels to break out.
All right, so cautious on the index, 23,700 to 24,350 is the broad range that he's spoken about. Manish, I have to ask you this about Reliance. The time you joined Reliance, you had, looked at Reliance at a time when it was pre-bonus, given a target price much lower than what it was that time. And now, as we look at it, it's looking like it's bouncing back from the lows. It's about 6 to 7% from the lows that we've seen the stock move higher. What are your targets on Reliance now from here on? Where does the stock go?
Well, Mangalam, here too, we have gone range bound. In fact, when we start preparing for the show, Today was like taking a lot of time because most of the heavy weights have either gone range bound or you have like blips of upside or downside and they again start calibrating towards the averages. Reliance is no different. I think we would need to evaluate it on the upside only post 1350.
All right, Manisha, quickly tell us your stock recommendations as well.
So I'm working with two trading calls. The first one is a sell call on NTPC for a target of 350, stop loss of 365. The stock has been in a downtrend and is clearly facing resistance at higher levels. The recent support of 365 has been disrespected too. Since we do see some up move in the mid cap, my buy call is on a mid cap stock, which is Aditya Birla, ABFRL, for a target of 350, stop loss of 300. The stock has recently taken support at 280, 290, and we are now in a buy breakout zone on the back of good volumes. This move could extend until 350.
All right, we take that point. Thank you so much. AVFRL up around 2%. On the other side, we'll talk about RBL Bank and Bajaj Finance. Both mutually agree to stop issuance of new co-branded credit cards. What happens to the business on this? We will get you more on this story when we return. Welcome back. We do have a bunch of stocks which are now spiking. Varun Beverages, the latest entrant on, we have the latest entrant on the F&O side of things doing extremely well. But important to know, the government has scrapped windfall tax on ATF crude products and petrol and diesel product exports. That's a positive. So we'll keep an eye out on this in particular, largely because there was a rate on the Brent above which if crude prices did go by, there was a windfall tax. I believe, if I remember correctly, close to around $85 per barrel on that one. Now that, Brent is lower at around $72 per barrel, it has been scrapped. Doesn't change things immediately, but it is a positive were oil prices to go above that $85 per barrel mark. Positive news for all these upstream oil companies, the likes of Oil India and ONGC. The other stocks on our radar are RBL Bank and Bajaj Finance, trading with cuts after they mutually terminated their agreement to issue branded credit cards. Ritu joins into the details of that one, though stocks have recovered from the lows as well. Ritu.
Well, yes, RBL Bank has ended its 8-year-long co-branded credit card partnership with Bajaj Finance, citing significant changes in synergies. Now, while RBL Bank will continue to service the existing portfolio, which is about 3.4 million cards under the partnership, it will not be issuing any fresh co-branded cards with Bajaj Finance. Now, this has not really come as a big surprise because if you see, RBL Bank has been reducing its dependence on Bajaj Finance with the co-branded cards with them coming down to about 37,000 as of September from 1.26 lakh a year ago. In fact, 64% of RBL Bank's credit card origination is now through direct sales and other co-branded partners like M&M Finance, IOCL, IRCTC and TVS Finance, and its credit card origination through Bajaj Finance had already come down to 36% as of the second quarter from about 65-70% 18 months ago. Why the move? Well, first, of course, the concentration risk, and therefore you've been seeing the bank reduce its dependence on Bajaj Finance, and also largely tighter co-branded card regulations from the RBI. Now, the street believes this move could constrain RBL Bank's potential credit card market share in the medium term. So Morgan Stanley says this is net negative for medium-term earnings growth overall. Investec expects the headline credit growth to also come down by about 200 basis points to 13 to 14% in FY25, while Citi says the earnings impact will be determined by how RBL Bank is able to transition the lost partnership business to direct sourcing and new partnerships scaling up.
Ritu, thanks a lot for that. And time for a short break. On the other side, Manisha Gupta joins in with Siraj Hussain, the former Union Agricultural Secretary. Stay tuned. We'll be right back.
Firstly, happy birthday. I think 25 years is a long, long time. We turned 10 at Swiggy a few months back, and we were like, 10 is already like a great milestone for a company to be around. So 25 years is a long, long time. We love the work that CNBC does, and wish you many more years of amazing work.
Welcome back, and joining us on the show now is Mr. Siraj Hussain. He's former Union Agriculture Secchi. Mr. Hussain, thank you so much for joining us. And, just as you would think that major elections are done with, the Rabi sowing is begun, delayed though, you have the farmers' protest coming in back again. I know you're in Delhi. I don't know how it is getting out in Delhi today with so many advisories on road. But how do you read? I mean, there's a whole list of why the farmers are protesting yet again. It is from legal guarantee on MSP. This we've heard before. Pension on farmers, labour lands, no hike in electricity tariff, reinstatement of Land Acquisition Act, farm loan waivers, employment for the children of landless farmers. It's a list which comprises 8 to 10 demands, as it were. How are you reading into this?
Actually, I'm speaking from Noida, where this agitation is concentrated. Actually, it is a localized agitation. It has been going on since about 2007 or so, when the state government acquired land for expressway, which connects Greater Noida with Agra. So since then, and in fact, even before that, when Noida Extension, what is now called Noida Extension, land acquisition was taking place, the farmers had been agitating since then. The main reason is that the compensation which is given to farmers is much, much smaller than the rate at which the authorities later on allocate land. So obviously the farmers know that the authorities are going to make a lot of money out of it. But recently, the Supreme Court upheld the urgency clause invoked by the state government for acquisition of land for Yamuna Expressway. So this legal battle has been going on for at least 2 decades, and all these demands relating to MSP, etc., are additional. The Noida farmers know that their agitation is not really for these demands.
Okay. But it really seems to be gathering more and more strength, because as of now, we understand that Bharatiya Kisan Parishad perhaps is doing it, and there are farmers' bodies in Kerala, Uttarakhand, Tamil Nadu also joining this from 6th, and then there are farmers protesting at Shambhu border. That has been going in for some time as well. They would also join in. So do you see this becoming a bigger movement in that sense?
I do not think it has the traction to become a bigger movement. The reason is that farmers are right now very busy in Rabi plantation. So they are busy in sowing their crop. But I must say that this issue relating to compensation of land has been going on for a long time. And in some states, for urbanization projects, a new method was tried under which the farmers whose lands were acquired were given some plot of land or some shop, some kind of sharing mechanism through which they can also gain from the enormous hike in the property prices. So we have seen in Noida itself, also in Delhi and Bombay, that property prices in the last 2 years, after stagnating for many years due to COVID, etc., they have gone up 70, 60, 70% across the board. So the UPA government had enacted a land acquisition law, which has been, for which the union government tried dilution, but it did not succeed in the parliament. So later on, the state governments were allowed to bring dilution through local amendments. It is a very real problem for the farmers because they are not equipped for the job market. Therefore, they do depend on farming for their livelihood.
So what you're saying is that this is more about the compensation, it's about rehabilitation and, of course, employment for the children of farmers more than anything, this particular one.
Right. This particular one starting from Gautam Buddha Nagar district, because now we know that a lot of land was also acquired for the airport, Jewar Airport. So there also the rates are skyrocketing now because the airport is going to be commissioned in the next few months. So obviously the farmers whose lands were acquired would feel that they should also have a share in the property boom.
All right. Mr. Hussain, I have one final quick question. This one is on Rabi sowing, and we do understand that it is slightly delayed of various reasons in various areas. Gujarat especially, Himachal is having its own issues right now. Are you concerned right now, or you think December is just about started? We have this whole month to look at numbers.
Actually, I would have been happier if the sowing had started earlier, but because of various reasons, especially in Punjab, the government did not have a storage space and therefore the harvesting was delayed. But if the winter continues to be cold, to the normal extent, then I do not think there is much reason to worry. However, if February and March again turn out to be very hot, as it happened in 2022, then the crop will be affected.
All right, Mr. Hussain, thank you so much for sparing time and joining us on the show today. Manisha, thanks a lot for joining in as well. With that, it's a wrap on this edition of Halftime Report. Business Lunch takes the action forward.